Let's take a look at AZZ and figure out if the stock is over or undervalued. I give a lot of high-level information. I also dig deep into the financials, so stick around for the whole video. You'll definitely learn a lot. Let's get started with the model. This is a mid-cap company, 2.4 billion market cap. They're trading at $79 a share, and they have 30 million shares outstanding. AZZ provides galvanizing and coil coating solutions. It offers metal finishing solutions for corrosion protection, including hot tip galvanizing, spin galvanizing, powder coating, and also plating to steel fabrication. You could find their products on bridges and highways. They sell to petrochemical companies and all over the industrial markets. They also provide aesthetic and corrosion protective coatings for steel and aluminum for the construction industry, as well as the appliance industry, HVAC companies, and container and transportation markets. They were incorporated in 1956, headquartered in Fort Worth, Texas. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have 60 million of free cash flow in 2022. It fell to 13 million in 2023, then up 1,000% into 2024, 149 million, falling a little to 134 million in the trailing 12 months. Decent margins, 9%. It was as high as 12% in 2022. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 23, but positive the other time periods. 36 million in the trailing 12 months. Really low margins, only 2%. Revenue is a sales for the company, and that tripled from 500 million to 1.6 billion, likely due to an acquisition. They do pay a dividend, a little under 1%, but they can easily afford that dividend. They cover it 6.6 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows past year 4, that's 2.9 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $2.5 billion. We divide that by 30 million shares. And we get a calculated stock price of $83. They're trading at $79, so they're trading at a 5% discount. It's a buy according to the model. It doesn't look like there's that much upside with this stock, but it does look like a pretty safe and secure investment. There are 37 companies in the same industry as AZZ, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 111 million in CapEx, a little less than the average. These are the investments in property, plant, and equipment. Debt to equity ratio is 0.9. That is a little higher than the median. That means for every dollar of equity, they have 90 cents of debt. Their dividend is equal to the average. Cash pays the most at 2.8%. They're a really small company, 581 million market cap. Free cash flow is between the median and average. They rank 17th in market cap. They're trading at 2.2 times book value. That's a good ratio. 65 times earnings. They look pretty overpriced according to their PE ratio. Price to free cash flow looks real good. It's below the median average. They're trading at 18 times free cash flow. Price to free cash flow is stock price over free cash flow per share. Price to sales also looked pretty good at 1.5. That means their market cap is 50% more than their revenue. Revenue of 1.6 billion between the median and average. And they're still growing. Their 5-year annual revenue growth rate is 10%. Look at RBA, 27%. RB Global, or Ritchie Brother Auctioneers, is a pretty popular company in this industry. I've actually used their website to buy a product in the past. You could think of Ritchie Brothers as eBay for really heavy equipment. It's an auction site. They sell really heavy equipment like tractors, cranes, excavators, dump trucks. So to summarize, I have them trading at a 5% discount, ranking 6 out of 10. I think it's a good stock. Would I buy a 5 out of 10? I need to learn a little more about the company. Ratios are okay, 6 out of 10. A weak PE, a good price to free cash flow. I do like their financials. Revenue up 200% since 2022. Free cash flow up 114%. So it's definitely moving in the right direction. Let's go through their latest 10Q. Here's their income statement, the 3 months ending 8/31/24, the 3 months ending 8/31/2023. And these two columns are the trailing 6 months. Revenue, 409 million. That's up a little bit. It was a little under 400 million last year. So it's a growth of about 2 to 3%. Let's see if they give a breakdown of the revenue. Of the $409 million of revenue, $233 million is in construction. That's up nicely from $217 million. Industrial is down, transportation is up slightly, consumer is down, utilities is up, and other is down. Other includes agriculture, recreation, petrochemical, also sales from recycling. Here's a different breakdown of the revenue. Of the $409 million, $172 million is in metal coatings, $237 million in pre-coat metals. And both have a similar gross profit, so the margins are much better in metal coatings. Their expenses are a lot lower relative to pre-coat metals. Most of their sales are in the US, $10 million in Canada. Let's go back to the income statement. Below revenue is cost of revenue. These are all the expenses directly tied to generating the revenue, $300 million. Gross profit, $103 million. Then you have SG&A, selling, general, and administrative expenses, $36 million. Similar to last year. Operating income is up. It was $61 million, now $67.6 million, up over 10%. They spend a lot of interest on their debt, $22 million, but it is lower than last year of $28 million. Looks like they're invested in other companies. They have earnings and equity investments, $1.5 million. Pre-tax income, $48 million, $12 million of taxes, net income, $35 million, $1.19 per share. They've added a lot of shares. Last year, $25 million, now $30 million. They probably added shares because of an acquisition, and they pay the same dividend, 17 cents like last year. Let's look at a balance sheet. Total assets, $2.2 billion. Current assets, $400 million. Current liabilities, $200 million. So they have a strong current ratio. Current ratio is current assets over current liabilities. So it's a little under 2. They don't keep much cash on their balance sheet. Nothing wrong with that. $150 million of accounts receivables. This is how much is owed to them when they sell on credit. $115 million of inventory. Of the $115 million of inventory, $112 million is raw material, $500,000 work in process, $3 million in finished goods. Contract assets, $94 million. Contract assets are similar to accounts receivable. A contract asset is conditional upon this company doing something, like fulfilling some type of service. There's nothing conditional for accounts receivables. They'll receive that money in due time, usually within 3 months, 6 months, whatever the contract is. Contract assets differ. It's not just passage of time until they get paid. It's conditional upon them doing something. The biggest asset is goodwill, $700 million. Let's look at their liabilities, $1.2 billion. Their biggest liability is long-term debt, $912 million. Here's a breakdown of the long-term debt. $75 million is a facility. $890 million is term loan B. They give a little more info on term loan B. The interest rate is SOFR plus 3.25%. And the revolving facility has interest of 275 to 350 basis points. Assets minus liabilities equals equity. They have $1 billion of equity. They raised $400 million from selling stock, selling their business. They profited $565 million from running their business. Retained earnings is the sum of all their prior net incomes minus the sum of the dividends they paid out. Accumulated other comprehensive loss are unrealized gains or losses. So they have an unrealized loss of $7 million. That's usually due to pensions or hedging contracts. Let's look at a statement of cash flows. They show the trailing 6 months. Their operating cash flow is really similar to last year, $119 million. That's how much cash they generate from running their day-to-day business. Net income of $75 million is accounting profit or loss. It's not actual cash. You see $75 million net income. If you go back to the income statement, you'll see $75 million of net income. Since the statement of cash flows is trailing 6 months, net income for the 6 months ending 8/31/2024. Last year was $57 million, which is right here, $57 million. That's how the statement of cash flows and income statement are connected. They spent $60 million in PP&E last year, $43 million. They have a lot going on in their financing section. They added $300 million of common stock. They use that money to redeem preferred stock. Preferred stock is higher in a capital structure. In the event of default, preferred shareholders get paid before common shareholders. Common shareholders get paid last, usually nothing at all. They borrowed $190 million on their facility, their revolving credit facility. They paid down $148 million. They paid $90 million on long-term debt and finance lease liabilities, and they paid $13 million in dividends. Last year they paid more, $16 million. Let's look at a stock on Simply Wall Street. Its last price, 78, 2.3 billion market cap, up 0.6% in the past week, up a solid 74% in the past year. Here's a stock price since 1990. It had a nice steady run up to 2008, breaking through 20. Then the Great Recession came, it fell to below 10. Then Then from 2009 to 2016, it did well, up about 500-600% to close to $70. And then it fell to the low 20s in March 2020. It shot up to 56 in March 2021. Then it bottomed out to 34 in October 2022. But since that point, the stock has done really well. It reached its all-time high around $87 in mid-2024. Simply Wall Street's valuation is 96. They say the stock is 19% undervalued. Let's look at the data. Let's look at their DCF. So they use a WACC of 8%. That's not too low. Usually they use a really low WACC. And they go at 10 years in their DCF model. The first 4 years is what I use for my DCF. So 106 million of free cash flow in 2025. They grow that to 200 million by 2034. That's not too aggressive. And then they do a terminal value like me. They PV that, it's 1.8 billion. Then they add that to the PV of the next 10 years of free cash flow. So they say the company's worth $2.9 billion today. They divide that by 30 million shares. So that gives them a stock price of 96, or 18.6% undervalued. 6 analysts priced this stock at 96. That's almost exactly Simply Wall Street's valuation. I'm in the other direction. I say the stock is overvalued. Here's their revenue since 2013. It was 700 million. It broke through 1 billion in the beginning of 2020, then got cut in half to $500 million. But it's done real well in 2023, as most stocks have been doing. 1.5 billion of revenue. It's up a little bit now, close to 1.6 billion. They didn't have much debt for about 7-8 years, only 200 million in 2022. They added a lot of debt, 1.6 billion, but they paid some of it down. They're down to 900 million of debt. Equity crisscrosses their debt. It was higher for a long time till they added a bunch of debt. Then it was lower. Now their equity is a little higher. They have almost no cash on their balance sheet. Currently only 2 million of cash. Here's their dividend yield since 2015. It was 1.4%. The highest was 2.2% in 2020. That's when the stock came down. I wonder why they show a 0% dividend in October 2024. Because if you go to any website like the NASDAQ.com, it shows them paying a dividend in October 2024. Simply Wall Street says a dividend will be 0.9% by 2026. The CEO salary went from 700,000 to 940,000. Total compensation 4.4 million. Tenure as CEO 11 years. In the past year, there's been a couple of insider sells, some small buys. The actor Kurt Russell. 2,300 shares were bought in the past year from insiders, 24,000 sold. 94% of the companies owned by institutions, 4% by the general public, and 2% by insiders. The biggest shareholder is BlackRock, then Vanguard, then Fidelity. Mario Gabelli's Gamco owns 3%, Geode 2.2%, Martin Luther King Capital Management 0.8%, the CEO 0.8%. Their employee count was 2,900 in 2014, now it's 3,900. It did peak at 4,300 in 2020. And the ticker trades on the New York Stock Exchange and Deutsche Börse. So if you want to get a real deep dive into how to read financials and how to understand them well, click on the video in the top right corner. Thanks for watching.